Okay guys, in this video, we're going to talk about whether another stock market crash is coming. So we're looking at a chart of the NASDAQ right now. So the NASDAQ just touched off a record high. And as you can see here, there's been a slight pullback over the last couple of trading days. So, this was kind of the whole coronavirus sell-off and then things shot back up. So now we're kind of at that same resistance point that we were at earlier, and a lot of people are seeing their stocks go down and things like that. A lot of you guys are perhaps buying call options and hoping things will go back up. So I hope in this video I'm going to give you guys some insight on what I'm personally doing and some things that you can do to protect your positions and to kind of minimize losses and things like that, and to set yourself up better in the future. Before I get into that, guys, please give me a thumbs up for this video because it really helps the algorithm on YouTube. So what exactly is happening right now? Well, obviously stocks are up a lot, so you've got a couple things going on. The first thing is that a lot of people are pulling money out of the market. So I was doing a lot of research and things like that. I noticed some people have pulled their money out of the stock market, went and did things like maybe put a down payment on a house and stuff like that, because when markets are up at an all-time high, a lot of people are thinking, okay, I've made some money, now it's time to take some money off the table. So if you guys are up big, so if you bought some stocks like Carnival or American Airlines and things like that, and you guys bought kind of at this range here down in the bottom, or perhaps you bought some those tech stocks that have been beaten down, there's nothing wrong with taking a profit now. We're still basically at the all-time high, at least when it comes to the NASDAQ. That seems to be the most popular index. And then if you guys want to take a look at the Dow Jones, you can see that the Dow Jones is down pretty big too. So I kind of want to just focus on the NASDAQ because I think that's the market that's been really popping. So first of all, guys, nothing wrong with taking some profits. I like to do this all the time. So there's a couple things you can do. If you're just up big, you can just sell your entire stake. Another thing I like to do is I like to sell 50%. So perhaps let's say I put $1,000 in a stock. Well, if the stock doubles, then you can simply sell half the position, take your money back, and then you can just hold on to those shares if you really like the company. So that's another strategy that I do. That's exactly what I did with Genius Brands. I simply sold basically half the stake, and then took my money back and just held on to some of those shares. So then another strategy which you can do is you can simply kind of do a haircut, a position haircut. So what a position haircut is maybe you don't sell half the position, maybe you don't sell all of it, maybe you just sell 25% or 30% of it if you really like the company long term. Because I think people are getting worried and they're not really thinking in terms of 2021, 2022. And for you guys out there that want to really build some long-term wealth, you're going to need to hold your stocks for multi-years. So it's really hard to make a lot of money in the stock market just by holding a stock for like a couple months or a couple of weeks. I mean, people do it. They do trade up, but that's active trading, and it's going to take you literally hundreds or thousands of trades to trade up a lot of money. But for some of you guys, I know you guys are busy. You have work life, you have family life, and things like that. So what would be a good thing for you to do is, on a situation like this, just trim off a small position of your portfolio to kind of reduce your risk, and you're also kind of rebalancing at the same time. So guys, that's kind of the strategies what we do. We're still at a market top and we're still way up from where we were before. So now I want to talk a little bit more about whether a stock market crash is actually coming. So obviously a lot of people are saying, oh, we're down for a couple of days and things like that. So how do you know that the stock market is going to crash anyway? So there's a really useful indicator that you can use. It's called the Buffett Indicator. So what is the Buffett Indicator? Well, the Buffett Indicator is simply a calculation that has kind of been made popular by Warren Buffett. And what it does is it basically calculates two things. So as you can see here, by Warren Buffett, the percentage of the total market cap of the stock market in relative to the US GNP is probably the best single measure of where valuations stand at any given moment. So as you can see here, guys, I got this information on gurufocus.com. You can just type in Guru Focus, or usually I just type Buffett Indicator into Google and it's the first one that comes up. Anyway, so as you can see here, what it does is it's showing us basically the total stock market valuations and then the USG DP numbers. So according to this ratio, stocks are currently overvalued. So basically the historical ratio is 145%. That means that the total stock market is much greater than the GDP. And over time, these numbers should be pretty similar, right? Because how is the stock market going to be worth way more than kind of what America is producing? So as you guys can see here, I can give you guys some more information on this. This is basically what we're looking at. So according to this ratio at 145%, the stock market is significantly overvalued. And to give you guys some perspective, this was basically the coronavirus dip, and that ratio came down to about 120%. So that was a nice time to buy. So now this ratio is starting to get higher. So this is kind of one of the reasons why people think that a stock market crash is coming up, guys. This indicator is very, very accurate. It's very, very useful. And to give you guys some more perspective, let's just move this back even more. So as you can see here, back here during the whole financial collapse, you can see that according to the ratio, if I just move this back here, go to all. Okay, so as you can see here, this indicator has been pretty accurate at basically predicting market collapses. So here, as you can see here, this was the dot-com bust. There was a market crash. And then this was the financial collapse. That indicator was over 100%. So now here we are currently, basically this was as you can see here, this one was the coronavirus kind of basically meltdown. So this indicator is pretty accurate. As you can see over time, basically when this ratio has run up a ton, there's been a huge market correction. So now, what's in store for the market right now? Well, the good thing is that, the economy is recovering and a lot of people are going to be taking profits, I think, like that. But I think there's a couple of things that you can do with your positions on what I'm doing personally. So if it's a stock that I just bought basically because of this kind of dip, then I've either sold it or I've just given it a haircut. So some of the stocks I like, for instance, similar stocks like Genius Brands and Solo, those are kind of two of the cheaper stocks that I gave a haircut for. I just still hold some shares. Now, for my longer term holds, my stocks that I really like, but I mean the stocks that I plan to hold for 5 to 10 years, stocks like Uber, stocks like Canopy Growth, stocks like Match. These are just a couple of stocks that I personally have in my longer term portfolio. I'm just adding on dips because I want to hold these stocks for basically the rest of the decade, especially Uber. Uber was one that I added on the dip today. I just felt like it's still under its IPO price. So guys, that's what I would do for this situation. To wrap things up, give you guys some more information, I would definitely, sell, take some profits. You guys have stocks at the top. And if you guys don't want to sell, I know a lot of you guys out there, maybe you're down a little bit and you want to hold on your positions, use put options. So I really need to make a video tutorial on this, but I think it's pretty straightforward how this works. So, with put options, it's just so easy. So you just simply, I'll show you guys exactly what I'm talking about. Okay, so let's use Tesla as a great example. I think Tesla is a nice example. The stock has run up a ton. It tapped $1,000. So maybe a lot of people are thinking, okay, basically hit around $1,000 a share. Perhaps I either want to protect my position. So put options are really important because if you have a position in a stock, some of you guys, you might have 100 shares, 1,000 shares, 10,000 shares of a stock, and maybe the stock's down a little bit and you're like, well, I want to hold on to it and see if it can go higher. Well, you're going to have to buy put options. So, of course, I hope you guys are using stop loss orders whenever you have a lot of money in a stock. That is basically a requirement when you have a big position. You definitely want to cut losses early. You don't want to like hope and pray that a stock is going to recover. So for me, if a stock dips down below like 10%, I like to just cut my losses. You're not going to win every single trade. But if you like the stock long term and you want to protect your position, I think a great example is Tesla. Tesla is a stock that I love long term. I think Tesla's going to be $3,000 a share, but I don't know where the stock is going to go in the short term. No one has a crystal ball. So this is why we use put options. So as you can see here, I'm on Yahoo Finance. I have the options chain here. So this is call options. So this is not the one we want to use. We want to scroll down here and we want to look for puts. So what is a put option? Well, a put option is basically a contract to sell, but not the obligation at a certain price. So it allows you to control a lot of shares, 100 shares per contract, without spending a lot of money. So what a good thing to do would be, okay, so let's say, okay, great. So as you can see here, we're looking at these puts, right? So what this will do is if you buy one of these puts, right, this will protect your position, because if the price of Tesla stock continues to go down, these puts will go up in value, and you can actually exercise these puts and sell your Tesla stock at that strike price. So let's say Tesla stock dips to, like, I don't know, $900, right? If you bought a put here, you can exercise this put by the time the expiration date ends, and you'll be allowed to sell that stock at $985. Or what you can do is you can simply just resell that put back into the market to kind of recoup some of the losses that you experienced on Tesla stock. So that's just definitely a way to kind of protect yourself from downside risk, guys. You want to use those two strategies. Number one, you want to lose stop loss orders or a trailing stop, depending on which one you prefer. Probably the easiest is just stop loss. You just set, that's the price, that the max that the stock's going to go down, and before that happens, executes the trade. The second strategy is put options. You simply buy a put option. That way, if the stock does come down, you can still sell it at that strike price or recoup some of your gains. So those are kind of the two strategies, guys, that I would be using right now. Remember, the stock market is still up a ton, even if it goes down a little bit more, guys, for so long, ever since over the last couple of months. So I hope you found some value in this video, guys. Please give me a thumbs up and subscribe to my channel for more informative content. Just smash that red subscribe button to get more updates. I post videos on the stock markets. That's it until next time, guys. Take care.